Welcome back to Nomad Investing. Today we're taking a look at Netflix, ticker NFLX, the streaming giant that revolutionized entertainment. With the stock up over 40% in the past year and trading above $1,000 per share, many investors are asking, is Netflix still a buy at these levels? Or is the best part of the story already behind us? Let's take a deeper look at the company, how it works, its financials, its future, and finally, what might be a fair value for the stock. Overview. Netflix started in '97 as a DVD rental service and has since evolved into the world's leading streaming platform, with now over 300 million subscribers worldwide. The company's main business is simple. Subscribers pay a monthly fee to access Netflix's massive library of films, TV series, and original content. But what truly sets Netflix apart is its scale and brand power. Its global presence now spans 190 plus countries, with international markets making up the majority of the new growth. Netflix also has become a major content producer, spending billions each year on original series and films to keep audiences engaged and loyal. More recently, the company has expanded into advertising-supported plans and paid account sharing, both of which have helped boost revenue without relying solely on new subscribers. It's also slowly entering into new verticals like gaming and live sport events, signaling a more diversified future beyond traditional streaming. Financials. Netflix trades around $1,100 per share, giving it a market cap of roughly $460 billion. Forward PE ratio is around 40, and expected EPS is around $25, which puts it well above the market average, but also consistent with high-quality growth companies. Revenue per share has grown impressively over the years, from just $9 in 2012 to nearly 98 TTM today. That's a compound growth rate of over 20% per year, showing how Netflix scaled from a niche service into global powerhouse. Operating margin has expanded from just 1% in 2012 to almost 30% today, thanks to pricing power and improved cost efficiency in content spending. Net income has also surged from only $17 million in 2012 to over $10 billion in trailing 12 months. Profit margins now hover around 25%, an incredible improvement for a media company. Free cash flow, which was negative for the most of the last decade, has finally turned sustainably positive. Netflix now generates nearly $19 of free cash flow per share, giving it plenty of flexibility for reinvestment or shareholder returns. Long-term debt sits around $14 billion, which is reasonable compared to $25 billion in total equity. That's a healthy balance sheet, much improved from its heavily leveraged past when content spending was funded mostly by borrowing. Overall, Netflix is now a profitable, cash-generating business, a big shift from its growth at any cost years. It's now grown to a top-quality business. Future. Let's start with the opportunities. Advertising expansion. Netflix's ad-supported tier is still in the early stages but growing fast. If it captures even a small slice of global TV ad budgets, this could become a multi-billion-dollar business on its own. International growth. Huge markets like India, Southeast Asia, and Africa are still under-penetrated. As incomes rise, Netflix has significant room to expand its subscriber base. Content and franchises. Netflix's strategy is shifting towards developing global franchises. Think Stranger Things, Wednesday, or The Witcher. Owning strong IP boosts brand value and reduces churn. New verticals. Ventures into gaming, live events, and sport broadcasting could open new monetization paths beyond streaming subscriptions. Risks. Competition. The streaming market is more crowded than ever, with Disney+, Amazon Prime Video, and YouTube all competing for screen time and content budgets. Content costs. producing and licensing high-quality content remains expensive. Cost inflation could pressure margins if subscriber growth slows. Market saturation. In mature regions like North America and Europe, subscriber growth is largely flat. Revenue growth must now come from price hikes, ads, or new markets. And one worthy risk to highlight here is YouTube. Unlike Netflix, YouTube content is user-generated, meaning production is cheaper, volume is massive, and the platform doesn't rely on billion-dollar content budgets. It's also completely free to use, with far more users globally, and it's literally the second most visited website in the world, only behind Google itself. That gives YouTube enormous reach and engagement advantages that Netflix simply can't match, especially among younger audiences shifting towards short-form and creator-driven content. But of course, YouTubers still don't produce high-quality series and movies yet. Valuation. What might Netflix actually be worth? Netflix's forward EPS is around $25, and analysts expect earnings to grow roughly 25% per year in the near term. There's little doubt that Netflix will keep growing. The real question is how much. For some context, Disney's peak operating margin has been around 17% and Warner Bros. About 18%. Netflix currently operates at roughly 24%. Which shows just how much more efficient it is at producing and monetizing content. That said, I don't think there's much room left to significantly expand margins from here. Most of the growth will likely come from revenues and new subscribers, not from squeezing out higher profitability. Netflix's subscriber count has grown close to 20% annually, but not every subscriber is equal. For example, I pay a lot less for Netflix in Bangkok than I would back home in Finland. So average revenue per user varies a lot by region. Taking all this into an account, I'll use a conservative estimate of 18% annual growth for the next 5 years, followed by 10% growth for the next following 5 years. And as always, I want 12% annual returns for my investment. At today's valuation, Netflix trades at a forward PE ratio of about 40, compared to its historical range of 25 to 60, with a long-term median around 70. Given its scale and quality, I think it's reasonable to expect the stock to trade around PE of 30 over the next decade. I don't see us going back to the 70x multiples of the past. Using these assumptions, I estimate a fair value of roughly $1,200 per share, which is just slightly above where the stock trades today. That suggests Netflix is fairly valued right now. Not cheap, but not overpriced either. The difference though is that Netflix still benefits from strong secular growth tailwinds. Global streaming demand, ad-tier expansion, and gaming experiments. So returns could remain attractive if management continues to execute well. However, investors shouldn't expect massive multiple expansion from here. We are likely past the days of 50+ PE ratios. Most future returns will come from revenue growth, not from valuation re-rating or margin expansion. And it's worth remembering, assuming 20% annual growth for a company this large is ambitious. If Netflix's market cap grew at that rate for the next decade, it would approach $3 trillion, which feels a bit too optimistic. Though, of course, a lot can happen in 10 years. So Netflix has successfully transitioned from a high-growth disruptor into a mature, highly profitable media powerhouse, with strong brand recognition, growing ad revenue, and global scale. It's positioned to keep compounding for years. But with the stock already pricing into much of that optimism, I'd call this a hold if you own it, but I'm not buying it type of a play, rather than a screaming buy. But if you truly believe they are going to grow over 15% per year for the next 10 years, go for it. But for the others, just put it at least on your dip watch list. And as always, this is not financial advice. Do your own research before investing. If you enjoyed this breakdown, hit the like and subscribe. And as always, do not lose money and safe travels. Bye bye.